So today's discussion is certificate for units in a property unit trust. Now to simplify this, a title unit is an arrangement whereby property is held on trust for a large number of investors. It is constituted by a deed regulating the rights, powers, and duties of the parties to the arrangement. Now, these parties are usually your manager, your trustee, your investors, and last being commonly known as unit holders. So, the manager purchases property and vests the title to it in the trustee, who at the outset holds on the trust for the manager. Now, sometimes the property is an estate in land or a mortgage thereof, but most unit trusts are in respect of a portfolio of shares. Now, the beneficial interest is divided into a large number of units which are sold by the manager to investors. Share unit trusts are of two kinds: fixed and flexible. In the fixed unit trust, the portfolio of shares is fixed and not except in special circumstances subject to a variation. The first portfolio of investments the first portfolio of investments in a fixed unit trust is described as a unit, and the beneficial interest is divided into subunits which the manager sells to the investor. A fixed unit trust deed will usually provide for the constitution of additional units matching the first portfolio, which will be vested in the trustee and then divided into the same number of subunits. Now, in the flexible units trust, the manager and the trustee has the power under the deed to vary the nature and the proportions of the shares, compromising the trust fund. The manager agrees to buy back units from any unit holder desiring to sell, and these units may be resold by the manager. The trust deed will usually provide that the trust is to come to an end at a fixed date, and one of several modes of dissolutions will operate. The property may be realized and the proceeds distributed amongst the unit holders. The trust may be converted into an investment company, or if the property admits of division in the specified, it may be so divided between unit holders. The idea of vesting property in a trustee for a large number of investors is not new. The unincorporated trading company was organized in such a way that the property of the company was held by trustees for the benefit of the investors on the terms of a deed of settlement, which prescribed the rights, duties, and powers of the members of the trading company. Now, if you invest in a unit trust or fund, your money is pooled with money from other investors and invested in a portfolio of assets according to the fund's stated investment objective and investment approach. Now, a unit trust is a fund which adopts a trust structure, and not all funds use a trust structure. In this video, the term fund will also refer to a unit trust. Now, if we look at unit trusts versus, for instance, your investment linked insurance policies, which are another way to invest in funds. The difference between these and a unit trust is that your ILPs combined life insurance coverage and investment components. Your premiums are used to pay for units in sub-funds of your choice, and some of the units are then sold to pay for insurance and other charges. If your main goal is invested or investment, you may wish to consider unit trusts. Sometimes the ILP sub-fund that you are interested in may also be offered as a unit trust without insurance coverage, however. Now, your returns from unit trusts: if you invest in a fund by buying units in the fund, there is a capital gain when the price of the units rises above the price you paid for such fund. Now, some funds pays out in dividends, and the price of each unit is then based on the fund's net asset value divided by the number of units outstanding. The net assets value of a fund is the market value of the fund's net interest, like your investments, cash, and other assets, minus expenses payable and other liabilities. The net assets value is usually computed daily to reflect changes in the price of the investment held by the fund. Now, funds are not principal or capital guaranteed. You may lose a substantial amount of money if you invested in a certain situation. The risk of investing in the fund are described in the product offering documents such as the prospectus and the product highlights sheet. And fees can also reduce your returns substantially, and regardless of how well or poorly the fund performs. Even if your fund's value has been fairly stable, the fees you pay will over time reduce the value of your investment. Now, why do you invest in funds? So funds invest in a diversified range of assets. A fund's diversified portfolio means risk can be better spread over the assets in the fund. Investing in funds may not be for everyone. So before you invest, make sure that you do the following. You want potentially higher returns, but are also prepared for variable returns, which include the risk of losing a substantial part of your investment. You also need to understand how returns are calculated or the factors that affect returns. So you need to understand the fund's investment objective, strategy, or approach. You need to be familiar with the fund manager and the fund's track record. This is very important. And then you also need to understand the risks associated with the fund. So some funds use financial derivatives for hedging or investment purposes, and you should be aware of the risks associated with the use of financial derivatives, including risk that the provider or counterparty of the financial derivatives defaults. You need to prepare to have your money tied up for a long period of time if you are going to invest. Now, as funds are exposed to market ups and downs, investors who stay invested long enough may be better able to ride out the downturns. You should also have adequate financial resources so that you won't have to liquidate your funds during a market downturn. If you need to convert your investments to cash in short term to meet specific needs, some funds may not be suitable for you per se. However, I'm going to discuss the types of funds, and there are different types of funds available, and each has its own investment objective and investment approach or strategy. The investment objective may be capital appreciation or to generate income. The fund manager can decide that the fund's investment strategy to achieve the investment objective and what assets to buy or sell. So the fund with the same investment objective may use different investment strategies to achieve the same goal. You should ensure that the fund's manager's investment style is in line with your own investment objectives. So when choosing a fund, you need to consider the following things that I'm about to disclose. So you need to consider. You need to consider what assets the fund invests in, the investment strategy or approach, the risk and return profile of the fund, the passive or active management, and also you need to consider if you change your mind, or do you have a right to cancel the investment, or in when you change your mind about your fund purchase within 7 days, or by law you can change your mind about your fund purchase within 7 calendar days. There will not be any administrative penalty for cancelling your purchase within that 7 days, but you might suffer a loss if the fund has fallen in the market value after you had bought it. So if the market value of the fund has risen, you will get a full refund of what you paid for the fund, but you will not be entitled to the gain. In either case, the sales charge will be refunded to you. Now, what are the risks when investing? So some of the risks associated with investing in unit trusts includes what I'm about to discuss, which is you do have a market risk, obviously. Now, the fund's NAV or trading prices will be affected by changes in the value of the assets in the fund that in turn are affected by changing economic, political, or market conditions. You also have a liquidity risk, which means that there is no secondary market for funds that are not listed. Hence, you can only redeem your units on the fund's dealing days. The secondary market may also be illiquid for funds that are listed and traded on a securities exchange. This may affect the prices at which you buy or sell. You also have an interest rate risk. So funds that invest in bonds, debentures, or other debt securities will be exposed to interest rate movements because the prices of debt securities tend to move in opposite direction to interest rates. For instance, debt security prices generally fall when interest rates rise. Another risk is foreign currency or foreign exchange risk. Funds that invest in assets dominated in foreign currencies may be exposed to adverse currency movements. The fund's currency base may also be different from your own. Then you do have a counterparty risk. Funds may be exposed to the risk that the counterparties that they trade with is unable to meet its payment obligations due to a deterioration of the counterparty's financial situation or otherwise. Another risk is how a unit is priced. Or let's look at how a unit is priced. The way a unit in a unit trust is priced is a simple equation. The assets of the unit trust are the shares, bonds, cash, and or property that the unit trust owns on behalf of investors. The value of these assets are generally updated daily, but sometimes weekly, dependent on the unit trust. The operating expenses comprises fund management fees, operating costs, which includes trustee and custodian fees, audit fees, or their service fee and bank charges, transactional costs for buying and selling shares, and VAT. Once operating expenses are subtracted from assets, the sum is then divided by the total number of units bought by investors. Now, when investing, whether it be in unit property trusts or in foreign markets, etc., you always need to consider the risks involved. And you always need to decide first, before just jumping into the investment process, one always needs to do proper research as to the type of investment that you will make, what are the risks involved, and can you can you generally change your mind once you have invested, and what are the risks thereon? Now, if you guys have enjoyed this video and it has taught you something new, then please do like and subscribe on our YouTube channel. Click on the bell button for post notification, and also check out our website for examples and plenty more documents for your perusal and consideration. Stay